two real estate deals, almost identical. Same market, same numbers, same profit. But one investor keeps most of the money. The other loses a massive chunk to tax. Not because they made more, not because they did something illegal, but because of how the deal was structured. And here's the part that catches people off guard. Sometimes you can owe tax before the cash even shows up. That's the trap. Same deal, same profit, completely different outcome. And it's almost never luck. It's design. Welcome to Ivy Smart Tax. This is our Tax Decode series. We don't just explain tax rules. We break down how the IRS actually sees your deal. Because what matters is not just what the property is, it's how the deal was built from day one.
So the goal is not to chase a lower tax rate.
No. Making money is step one. How that money comes out decides how expensive that money becomes. Here's something most people completely miss. The IRS is not just looking at one deal. They're looking at your pattern. Buy, fix, sell. Do that once? Probably fine. Do that again and again and again. Now the IRS starts asking a different question. Is this really an investment, or is this a business? And that one shift can completely change how your income gets taxed. What you thought was capital gain may start looking like ordinary income. And once that happens, higher tax rates, possible self-employment tax, and fewer benefits.
So it's not about what I call the deal, it's about what it looks like I'm doing.
Exactly. The IRS is not listening to your label. They're watching your behavior. Two people can sell similar properties, but if one person does it repeatedly, that pattern tells a completely different story. And that's where people get caught. Because the risk is not just one deal. It's the story all your deals tell together.
So one deal doesn't trigger it, the pattern does?
Exactly. A lot of people don't lose on tax because of profit. They lose because of pattern. Now, let's talk about a very real trap. The market slows down. The property doesn't sell. So the owner says, fine, I'll do seller financing. Let the buyer pay me over time. At first, that sounds smart. You solved the sale problem. But tax-wise, that's where things can quietly go wrong. Because a lot of people assume if I get paid slowly, I'll pay tax slowly. That is not always true. If the deal falls into a dealer-type situation, you may not get the installment treatment you were expecting. And that creates one of the worst outcomes. The tax shows up before the cash does.
Wait, so they fixed the deal, but made their cash flow worse?
Exactly. From a business perspective, the deal works. From a tax perspective, the timing breaks. The IRS is not asking, did you get paid yet? They're asking, when is this income recognized?
So the buyer can pay slowly, but the seller might not get to pay tax slowly?
That's the trap. You think you're setting up a flexible payment plan, but what you may actually be doing is accelerating your tax while delaying your cash. And that mismatch is where people get squeezed. So now the real question becomes, can you control the timing? Sometimes, yes, but not at tax time. It has to be built into the deal from the very beginning, because once the structure is set, the tax timing is often already locked in. For example, in some situations, a lease option type structure may affect how and when income is recognized. Now, this is not about this structure is always better. That's not how tax works. This is about understanding that timing is something you design, not something you fix later.
So instead of one big tax hit, you're trying to control how the income flows over time?
Exactly. Because the problem is not just how much tax you pay, it's when you have to pay it. And if the timing is off, even a good deal can feel like a bad one.
So tax is not just numbers, it's timing pressure?
Exactly. In real estate, timing is how you manage pressure. Now we get into one of the most misunderstood ideas. I have an LLC, so I'm fine. That's not how this works. Having an LLC does not automatically separate your activities for tax purposes. The real question is, did you actually separate how the deals operate? Your investment deals, your development deals, your sales activity. Are they truly running on different tracks, or are they all mixed together? Because if everything is in one bucket, The IRS may treat it as one combined activity.
So it's not enough to say, this one is an investment, isn't it?
Exactly. In tax, I intended it to be doesn't carry much weight. Your structure, your documents, your cash flow, and your day-to-day behavior all have to tell the same story. Otherwise, the IRS just sees one big pattern.
So it's like calling it one thing, but everything you do shows something else?
Exactly. You can call it an investment, but if it looks like a business, it's going to be taxed like a business. Now let's look at another area where people get surprised, contributing property into a partnership. A lot of people hear that and think that's tax-free. And sometimes that's where it starts. But once debt is involved, everything changes. Because when you contribute a property with a mortgage, the IRS may look at it like this. Did you just get relieved of part of that debt? And if the answer is yes, that can be treated like you received cash, even though no cash actually came in.
Wait, so no sale, no money in my account, but tax can still show up?
Exactly. That's one of the most confusing parts of partnership tax. In real life, it feels like, I just moved the property. But from a tax perspective, if your share of the debt goes down, it may be treated like a distribution. And if that amount goes over your basis, you can trigger taxable gain.
So basically, I didn't get paid, but the IRS says, we think you kind of did.
That's exactly the disconnect. And that's why no cash does not always mean no tax. Now let's talk about another high-risk area, disguised sale. Here's the simple version. You put property into a partnership, and then money comes back out pretty quickly. From your perspective, you might say, that was just a contribution, and then a distribution. Two separate steps. But the IRS may look at it differently. They may ask, was this really two steps? Or was this actually a sale, just split into pieces?
So the paperwork says one thing, but the IRS might ignore it?
Exactly. If property goes in and money comes out close together and connected, the IRS may say, this isn't a contribution, this is a sale. And once it's treated like a sale, the tax comes now, not later.
So timing here is not just detail, it's evidence?
Exactly. In real estate tax, timing tells the story, not just the documents.
So just because I label it a certain way, doesn't mean that's how it gets taxed?
Exactly. Labels don't control tax. Reality does. And even when a structure looks correct, there's one more layer that matters: reality. Because the IRS does not just look at documents, they also look at what is actually happening. Is there real ownership, real economic risk, a real holding period? Or is it just a well-written structure on paper? Because if the substance does not match the form, the IRS may ignore the structure and follow the reality.
So the biggest risk is not bad paperwork. It's good paperwork with nothing real behind it?
Exactly. That's where a lot of structures fail. They look strong on paper, but collapse under real-world scrutiny. And here's the part you can't fix later. You can't go back and create a holding period. You can't go back and add real economic risk. Once the deal is done, the structure is already tested.
So this is not about filing the return correctly, it's about building the deal correctly.
Exactly. Because tax doesn't just follow what you write, it follows what actually happened. By this point, you can probably see the pattern. Tax results are not just about how much you make. They come from things like what kind of income this is, how the asset is held, how the cash actually moves, and when the tax gets triggered. A lot of people think the tax return is where the problem gets solved, but in reality, most of the outcome was already decided when the deal was structured.
So the tax return isn't the decision, it's the result?
Exactly. It's the reveal. That's why real strategy doesn't start with, can I deduct this? What's the tax rate? It starts earlier. What is the logic of this deal? Where is the risk? How does the exit work? Because once you think this way, you stop reacting to tax and start designing outcomes.
So the difference isn't just knowledge, it's how early you see the structure?
Exactly. And as deals get bigger, small mistakes get expensive. A classification issue, a timing mistake, the wrong structure. Individually, they seem small, but together, they create very different outcomes.
So the real win isn't finding one extra deduction.
It's avoiding the wrong path from the start. That's why strong tax strategy is never just one move. It's layered. Classification decides what rules apply. Structure decides how the money flows. Timing decides when the tax shows up. Entity design keeps everything working together.
So it's not about one smart trick. It's whether everything actually works together.
Exactly. Because when these layers align, the same deal can produce a very different result. But when they conflict, even a good deal can become very inefficient. So here's the main takeaway. Classification tells you what kind of tax game you're in. Structure tells you how expensive that game becomes. And in real estate, the deal structure itself is the tax strategy.
So the goal is not to chase a lower tax rate. It's to build the deal correctly from the beginning.
Exactly. Because if you wait until tax season to think about tax, you're already too late. By then, the deal has already decided your tax outcome. That game becomes unrealistic. And in real estate, the deal structure itself is the tax strategy. If you want to understand how real estate deals actually get taxed before they get expensive, subscribe to Ivy Smart Tax. We break down real tax logic so you can see the risk before it shows up on your return. And just to be clear, this video is for educational purposes only. It is not tax advice. Every deal is different, and the tax result depends on your specific facts and how your deal is structured. Before making decisions, always consult your CPA or qualified tax advisor. Because in real estate, if you build the deal right, the tax usually follows. But if you don't, the tax shows up anyway.